Hello and welcome to 5 Minute Friday. This show normally comes to you live on Instagram, but this week I am coming to you on LinkedIn and with a very special guest, Stephen Seidler from CMG Home Loans. Stephen, how are you?
Great. Thank you, Tricia. Happy
Okay,
Friday.
super cool. So Stephen is one of the two partners in CMG Home Loans. Stephen, will you explain to everybody what you do, the market you work in, and how you really stand out from other loan providers? Well, mortgage providers.
Sure. In a nutshell, CMG Home Loans is a mortgage bank. So there's a couple different types of institutions that you can get mortgages from nowadays, whether it's a big bank like B of A, Citi, Wells, or Chase, which are just direct lending big banks. Of course, there's credit unions. There's things like mortgage brokers where you're not working with their institution. They're packaging your stuff and sending it to other institutions. At CMG Home Loans, we're a mortgage bank, which means we actually do all of those. So we do direct lending, whether that's a Fannie Mae, Freddie Mac, FHA, direct lended banking type of loan. We can broker to other institutions if you need something that's unique, like an interest only or a 4-unit or an investment property type of loan that qualifies on its own rents rather than your income. So think of CMG Home Loans as a catch-all mortgage catcher's mitt that we do a little bit of everything.
That's fantastic. And where are you based and what markets? Is it all of California? Is there any other states? What are you doing?
Yes, CMG Home Loans is licensed in all of the 50 states of the US. I personally am just licensed in the state of California, but anytime I've been doing this a little bit more than 20, 22 years. So anytime I have clients that come and say they want to buy something out of state, I just refer them to one of our local licensed state real estate mortgage loan originators.
That's fantastic. So you do everything and you do it everywhere.
Correct. That's a quick summary to say. Yes.
Okay, super duper. And just one other thing. Do you work directly with clients or do you work a lot with real estate agents that, you collaborate with? What way does that work?
Sure. Most of our contacts come from real estate professionals, whether that's real estate agents or builders or even financial planners or real estate attorneys. Those are the ones that are generally creating the connections. But then we're working directly with the consumers, the clients, whether that's a first-time home buyer or a very experienced investor or anyone in between.
Okay, you've got it all going on. I love it. So one of the things right now, the interest rates, I know they're due to come down, but slowly, slowly. But with the current interest rate as they are, how are they affecting mortgage trends right now?
Sure. So interest rates, the hot topic, and it has been for many years. Of course, interest rates are really the tail that wags the dog here is inflation. It's the big word. So inflation, after mortgage rates being at 2 and 3% and artificially kept low by the government so long to try to help everyone through COVID and all of these most recent years, as inflation started to really skyrocket, and the interest rates were raised by the Fed, the short-term overnight interest rates, which are not the mortgage rates. The Fed doesn't control the actual mortgage rates, but those short-term overnight lending rates that other banks and institutions use to borrow funds and either grow, that cost of money got really expensive. And so that hopefully slows down the economy, which it has been doing. Inflation has been trickling down a little bit, albeit much more slowly than everyone wants. And so that's really causing interest rates to only trickle down slowly. We all know they will. We're at kind of a high point right now, and we know they will continue to come down, but it's coming down much more slowly because a lot of the inflation reports on jobs or CPI or CPA, those are coming in a little bit too hot for what the Fed wants to see. We're actually, Tricia, this is an interesting time right now. This week, we had a lot of reports where the scale is starting to tip. I got to get to the screen here. The scale is starting to tip a little bit right now with the reports that are coming in. And so we really think that interest rates are going to continue their slow slide down between now and the end of the year. And everyone's waiting for the magic Fed interest rate reduction where they actually lower interest rates for the first time. Originally this year, they thought it would be as many as 3 to 4. reductions by the end of the year. Now they're only forecasting 1 by the end of the year. And likely that'll be a small one, 0.25% reduction or something like that, to again slowly start the trend over the coming years of the interest rates going down. I think the consumer market is gotten used to the interest rates right now, which are generally for most people in the 6s or 7s for a mortgage, just to talk about a rough interest rate. Those interest rates, because of the tax deductibility, the power of it, etc., are now reasonable, sustainable interest rates for most people. So it's gotten most people off the sidelines, and they're being told the rates are only going to get better. So everyone's ramping up, and we're seeing, believe it or not, more purchases and more refinances, even just because of the small lowering of interest rates, which will hopefully accelerate in the coming year.
Okay, that's awesome, because you know what? You've explained something really, really well to a lot of people who I consider myself, even though I'm in the real estate industry, when it comes to mortgages, a bit of a layman, and we like to talk in layman's terms. So everybody's waiting for that Fed cut. But as you said, it's not going to be instant. It's going to be slow and steady, right?
Yes, correct. We are not going to see interest rates go down. There's too much greed in the general markets of the capitalistic markets to let things go that easily. So it should be a low, nice, predictable, steady ride down with interest rates. Yes.
Okay, and that's actually going to bring me to my next question. So what I want to ask you about, I'm going to skip ahead a little, and I'm going to
Okay.
ask you about, so a lot of people right now are going to buy and
Yes.
refinance later on when the mortgage rates come down, because we're
Yes.
told they're going to come down, and it's happening, and it's obviously a lot slower than we all wanted. But what are the pitfalls and what are the costs? Because a lot of people think it's just a simple case of, oh, I'm just going to call up my bank and I'm going to reduce my rate and everything's going to be beautiful. But it's a lot more complex than that, right? And there's a lot more to it. So can you explain that
Absolutely.
to everybody?
Sure. Being that we're at the top and will slowly be coming down, you're right. A lot of people will chase that interest rate down and refinance multiple times. And we've seen that in the past. We saw that in the early 2000s. We saw that after the mortgage meltdowns of the 2008, 9, and 10. Again, people would do 2, 3, 4, 5 refinances over the period of years to get their rates down to those lowest interest rates. Now, what's entailed in a refinance quickly? There's always going to be fees. Even a no-cost refinance has fees that are being covered by someone, maybe the bank. Generally, there's 3 fees. You're paying for a new appraisal, there's bank fees, and then there's title and escrow fees. A nice round average number for that would be $3,000 to $4,000 in California for refinance fees. Those can be credited by your lender. In fact, CMG Home Loans is going to be covering refinance fees for the next 5 years for our customers, because we know that rates are going to be coming down. We want to keep our customers. So management has said, okay, great, we're going to, and I think they put it into something called a rate rebound, or is the marketing term for it. But ultimately, we know that we're going to have to be covering those fees to keep the customers in these coming years for the refinances. Generally, it's going to take 30 days. We can do it faster, but generally it's going to take 30 days for a refinance, for that time to get the appraisal, the underwriting, all the documentation and everything closed. And the challenge, or I should say the pitfalls, I think you used that specific word, are as follows. What if you lose your job? Even if interest rates have come down, what if you lose your job? Now you can't refinance. What if home values have gone down a little bit? Not what's in the prediction, the low inventory, and especially if rates come down, everyone's expecting real estate prices to stay steady, if not continue to increase. So, but what if home values have dropped by 5 or 10%? And you were really close at buying, you only put 5 or 10 or 15% down. So you didn't have a lot of cushion, and now your value dropped, your equity has shrunk. You can't refinance. What if interest rates don't go down as quickly as everyone expects? Certainly they're going to go down, but now what if it's a year you're stuck with the loan, and the lender or the real estate person you've been talking with has said, no, you'll refinance in a few months, and now it's been a year. You have to have, what I like to use the word is cushion a lot in my business. You just have to have cushion, either on timing or on funds, so that if life gets in the way and you can't refinance right away, that you're not stuck in a home that you can't afford.
That's really, really fantastic advice. And one of the things, the keynote things I'm going to take away from that is that you guys are covering the costs. And I love that. That's
Yeah.
very attractive to buyers right now. And I'll tell you what, from my own personal experience, we bought a home about 2 years ago in South Carolina, and maybe it was a year and a half ago. And at the time, we we put down, what we wanted to put down, and we got a okay interest rate at the time. I think it was like 5.75, and we thought that was high at the time. And with the idea, we held money back with the idea that we refinance next year when the interest rates all come down. That didn't happen, of course. They're up
Yep.
more than 2% now. And yeah, so having that buffer, like you said, it's like
Yes.
sit back. Yes, it will happen, but it's going to take time. Like that refinancing isn't going to be when people say it's going to be, it's going to
Right.
be when it's going to be.
Yes.
So these are really good points. Thank you so much.
Thank you.
And talking about financing and everything else, I want to sort of gear and look towards first-time buyers and what that experience is like for them. To start with, can you explain, the pre-approval, how it looks, and the documentation somebody first-time buying
Sure.
be expected to produce? Because it's a lot. I mean, when our first time
I
buying,
remember.
they
I said, I remember our first time, especially because you were coming over from Europe. So it was very different.
we were so different. I mean, it's such a different process. So I think it is something that will really benefit, particularly first time buyers, if you can go through what they should expect.
Absolutely. So the key word here is time. Time is your enemy, or time is your best friend. It's never too soon to get pre-approved. Let me start with that. I have some people that I talk with 1 to 2 years before they buy a home.
Wow.
And all that they're or what they're gaining by starting that soon is the confidence that they're on the right track. Because for pre-approvals, we're looking at a few things. We're looking at your credit. Your credit, even when you think you have great credit, sometimes has erroneous mistakes on it. These TransUnion, Experian, and Equifax, the main 3 bureaus that we pull from, are dealing with trillions of transactions. There are tons of mistakes, whether it's being reported erroneously or it's just an actual mistake. It doesn't matter. I've been doing this 22 years. I can't tell you how many people that think they have 800 credit and realize they still have their authorized user card on from their parents who hadn't been paying it, and there's credit card late. There's always a solution if you have time. So I'm going to go back to time. If you find a problem on your credit report and it's as simple as fixing it because it was a junior senior issue, no problem. You send in the letters, you make the calls, and within a few weeks, within a few months, your credit is cleared and fixed. If you're coming to me 30 days before you want to buy your dream home and you're doing your pre-approval 30 days before, the day you get into contract, and all of a sudden I tell you have a credit problem and now you can't buy your home, or it's going to be a much more expensive interest rate, or you're not going to be as competitive with your offer because now you can't go in without contingencies. Time is what is going to heal you. So I always start with that first when we talk about pre-approvals and documentation. Knowing that you can't go too soon. The process is pretty quick and painless and easy nowadays, thanks to technology. You fill out an online application. Takes you 5 to 10 minutes. You're going to know all of the answers: name, address, social security, date of birth, where you work, how much money you make, etc., stuff like that. Once you fill that out, there's no cost or no commitment needed at these early stages. Then we're running the application, pooling the credit. We can do soft pools nowadays, which is great in case you really are a year out and you're like, oh, there's no reason for a hard pool. I have perfect credit. Now we do a lot of soft pools, and I see, great, the one soft pool we do was a 777 score, 787. I'm confirming your credit's great. Nothing looks bad. Then we don't have to do a hard pull until you're within, say, 3 months of a purchase time frame, something much more close than that. After the application, we get your documentation: pay stubs, W-2s, bank statements, tax returns, etc., blood samples, DNA sample. No, not quite. But don't be surprised if blood and DNA samples are soon a new thing to get soon. But we get all the documentation, and that can be uploaded into our secure portal, which is, again, very nice. You download your PDF directly from your secure banks, your banking site. with your from your big bank or credit union or who have you, and then you're uploading that PDF directly into a secure portal. It can also be emailed and gotten other ways, but that's probably the fastest and most expeditious way. All of this can be done in 24 hours. You fill out an application, you send in your documentation, we have your pre-approval run in 24 hours. That part is easy and painless, and as long as everything goes good, then it's kind of set it and forget it, and then you go out and house hunting.
Okay, so say you do find that the credit rating is wrong. Do you help your clients fix those problems, like the errors that they find on the
Great
three main
question.
credit? Yeah.
If just because I've pulled in my years, let's call it 10,000 credit reports or some ridiculous number, obviously I've gained a lot of skills just by looking at it and knowing what works. However, there are true experts in the credit repair world. Now, I always, caveat emptor, buyer beware, be cautious in the credit repair world. As in every industry, there are slimy people, and there's ones that will make you pay thousands of dollars up front that may or may not be able to do what you need to do. Most very good credit repair companies will not make you pay up front. Maybe there's $100 initiation fee or something, but very small money up front. And then they charge you a monthly fee, $80 to $100. I'm making up these numbers. I don't know exactly. And over the period of 3, 6, 9 months that you're working with them, you're paying this money to get your credit actually repaired. They will send in letters into the bureaus, the credit bureaus themselves, to get erroneous and even old and outdated stuff off of your credit report and cleaned up. It's very powerful. It's used all the time. It uses the Fair Credit Reporting Act in very legal ways to get things deleted off of your credit report. So yes, I can help people guide, but for the ones that actually have bad credit, and I'll define bad credit of, call it 620, 640 and under, then you probably want credit repair to help you, because they can do it much more quickly than even just the advice of me giving it to you and you doing it on your own.
Yeah, no, 100%, because it's a minefield, right?
Yes.
That's why you go to the experts.
Good way of putting it. It's a minefield. Anyone who tells you the mines don't exist, run from them like crazy. The ones like I use that actually analogy and metaphor. I say, I'm not telling you there's no mines. I just know where most of them are. So follow me and we'll make our way through.
Yeah, exactly. Really, really good point. Staying with first-time buyers.
Yes.
Now, the market price of homes, it's high. So what are your tips for helping first-time buyers get on the real estate market? Even if it's as an investment, it mightn't be their first ideal home that they're going to live in themselves, or whatever it is. What are your tips for those first-time buyers getting in the market now, which is difficult?
Yeah, well, I think I'm going to go back to the last question about pre-approvals and time. It's talk to an expert, whether that's a mortgage professional at a mortgage bank or someone in the industry that can start to guide you on these things. Because the reality is, most people don't realize you can buy a home today in California. There's probably similar programs in every state, but of course, I'm only speaking specifically to California just because I am licensed and know it. Between Cal HFA and other down payment assistance programs, you can virtually buy a home for little to no money down. That sounds like I said, little to no money down. And the definition of that is FHA, Federal Housing Administration, government insured loans as a standard have a minimum down payment of 3.5%. Well, that's already pretty low, 3.5%. But there are grant programs that give you 1.5 to 3% of that 3.5%. So you can buy a home for 0.5% down and things like that. If your income meets or the house meets in the location, those are the two guiding factors. Sometimes there's income limits on first-time home buyer programs or down payment assistance programs. But the key is go talk to a professional and find out if you're thinking, I got to save 20% down. I want to buy a $600,000 condo for my first home. I got to save $120,000. That would be insurmountable for a lot of first-time home buyers. But if all of a sudden you say you only have to save $3,000 to $10,000 for a $600,000 home, all of a sudden that becomes a possibility. And especially when you start to throw in things like 401k loans, a very powerful tool, especially in California where incomes are high. You can take up to 50% or $50,000, whichever is less, it's a federal mandated number, from your 401k as a loan. No penalties, no fees, etc. So if you have $100,000 or more in your 401k, that means you can take the max of $50,000 as a loan from yourself. If you only had $50,000 in your 401k as vested balance, you could take up to $25,000 of that as a loan. That's a great source for first-time home buyers that people just forget. It's just off in their periphery and they just don't think about it, even though it's there as a tool. Gift funds from mom, dad, sister, brother, aunt, uncle. Gift funds are a very, very good way. And these are not the IRS gift laws. These just mean banking gift funds, which means you're getting that as a gift, not as a loan, and you don't have to repay it. So there's a lot of tools for first-time home buyers to show them you don't need that much down. And of that money down, even if you're putting 3.5%, 5%, 10% down for the standard conventional loans, for example, that you can use those from 401k loans and other sources. For example, we're so tight on time here, Tricia, that those are the highlights of those pieces. Yeah, for first-time home buyers.
Okay, so at the end of this, I'm going to share your information. So if you are a first home buyer, reach out to Stephen. He's got a lot going on here. There was a lot I wanted to go into in that, but I know we are short on time. So maybe you'll come back another time, because I really want to get on to the next question, which I think is of great interest to both to clients, to the consumer, and to real estate agents. And what I really want to talk to you about now is the NAR settlement. So for people who don't know what this is which would be people who are not in real estate. So the NAR made a ruling where traditionally you would see that the listing agent would pay the buying and the selling commission when you buy a home, so the buyer doesn't actually have to pay anything. Now that's changing, where the NAR is saying, well, you know what, the seller doesn't have to pay it anymore, which of course technically they never really did, but you don't have to pay it anymore. And in fact, the buyer, if you don't want to supply that the buyer has to pay the commission. So how is that going to work for buyers coming into the market? How is that? And let me know if I explained that well enough, Stephen. How is that going to affect buyers coming in? Because now they've got an additional cost that they hadn't worked out, that they didn't have to think about before. Well, they may or may not have this cost, of course, depending on who's listing the home. And how are mortgage providers handling it? What's the future look like?
Sure. This is probably the most fascinating question in a boring industry, so to speak, that we've had for a long time. And yes, you explained it. I'll probably make it a little more tactical for any of those first-time home buyers or people that are listening, that generally it is the seller that pays what was traditionally 6%, 3% commission to the seller's agent and 3% commission to the buyer's agent. And that was kind of a tradition. It wasn't a law, it wasn't a rule. It just became a tradition in the industry. And for the first time now, that 3% and 3%, total of 6%, which of course in recent times, especially California, has been negotiated down to more of probably a 5% has probably become more of a standard, if you ask me, 2.5 and 2.5. Well, still, regardless, one of those halves is now going to be shifted onto the buyer side potentially. And in California, if you're buying $1 million home, that's 2.5, 3%, that's $25,000, $30,000. Yeah. Well, those are extra costs that have to be put somewhere. It could either be actual closing costs, where a buyer is coming in with an extra check of $25,000 to $30,000 at close of escrow. I think that's going to be a hard apple for people to take a bite out of, especially in the transitionally, because for generations it hasn't been that way. So the buyers are going to be like, wow, instead of the standard $10,000 of closing costs between appraisal, bank fees, title and escrow fees, etc., now that number has gone from 10 to 40,000. Well, is that extra savings now? Where is that savings going to come from? So to answer that, the industry has to come up where this is going to be paid from. Is it going to be paid from concessions from lenders, for example? Will buyers that are well qualified say, well, can I take a higher interest rate and get a credit on the loan to pay for some or all of this? this comes to the crux of the question is who can pay what? And the answers come from a very, very written in concrete stone, well-established set of guidelines and rules, mainly dictated by Fannie Mae and Freddie Mac. These are quasi-governmental organizations that set the guidelines for 95%, I'm making up that number, of all of the loans that get closed in the United States. And they're the ones setting the minimum credit score guidelines, the minimum down payment guidelines, where you can work, how long you worked, etc. And some of these actually are specific guidelines about what are called interested party contributions, IPC. And they set maximums so that you can't come into a transaction and that a deal can be thrown way out of whack by a real estate agent throwing in all of their concessions or commissions to a buyer to make something happen. There's maximums that can be for all of these interested party contributions that can be thrown into the pot. And these guidelines are very strict and written into even what's called the secondary market, which is the buying and selling of loans. So when Fannie Mae and Freddie Mac say to us, CMG Home Loans as a mortgage bank, if you provide us a loan that fits in this box of guidelines, we will buy it from you. So that creates liquidity in the market so we can go out and sell more and people can keep buying homes. That process of secondary market liquidity is key to making everything running. Well, that machine has very strict rules about what kind of loans that can go into it. And these interested party contributions would mess with what can go into those pools without very old and rigid guidelines being changed. So it's in flux. Nobody knows the answer. If anyone says they do, they're making it up for the moment. But to make a very long and complicated story short, we don't know. And I think the industry right now is trying to come up with solutions for those buyers that are going to be forced to have $10, $20, $30, $40,000 extra of expenses that they just don't know how to cover if the seller is not going to cover it.
And that's very important, that word if, because a lot of cases, the seller will continue to pay them. So it's not something that most buyers are going to have to worry about, but it is something to be aware of when you are buying a home. And I also want to just circle back to the point where you said that it's very much undecided and that the rules are very strict around it. So if someone's telling you, don't worry about it, we'll work that into the mortgage, you're saying it's not that
right. There is no one has the power to say, don't worry about it, we'll work that into the mortgage with confidence. That is likely. Everybody wants this to work. No one's stopping and saying, hey, we want to halt the whole process of this entire buying and selling. The US government wants more homeowners, period. End of story. They will make a way and find a way to give everyone the leverage that is needed to come up with a solution. But this might not happen in month one. This is a very large, slow turning ship. In my opinion, this could take years, plural, to actually trickle down to make changes into our industry.
I actually totally agree with you.
That's just an unsupported opinion for the masses. But,
yeah. I actually think that's very sound opinion, because nothing happens just like this. A light bulb goes on and everything changes. It also takes people being educated about the change to trickle down, because this is not going to be something that is like obvious to everybody. Do you have time for one more question? Or
I do.
You do? Okay, super cool. So we've talked a lot about first-time buyers, and I just want to round it off about overcoming the most common mortgage hurdles. When you're applying for that mortgage, what are the common problems that you're going to encounter, and how can we be prepared for them as a buyer?
Sure. I guess I'll cheaply go back to my word that I like to use in this case is time. Most of the common hurdles that they run into is when they're not giving themselves that time. When people come to me, they do their shopping, they think they know where they want to buy, they find the home they want to buy, and then they come to me and say, can you get me pre-approved? And these might be people that even in their minds think they're very strong. Right now, I'm dealing with a father who's helping a son buy his first home, and he owns 2 businesses. In the real world, he makes good money. And he's one of my longtime real estate agents. So I know him well, both as a person and a businessman and as success. there is no doubt in the real tangible world of items that he is successful and makes money. But in the guideline world of self-employed business owners, we use net income to qualify. That means if you make $1 million of gross income for the year, but you write off $999,000 of income and expenses, and you only claim $1,000 of taxable expenses, I don't see you as $1 million business. I see you as a $1,000 a year business. Well, that can be hard to qualify for a loan sometimes. That hurdle to overcome can be solved with time. That means that we can either help people with their reporting, guide them on, okay, well, if you really want to make income, then you can't write off all of these expenses. I mean, if you want a loan to qualify, we're going to give you all of the different options. And most of those revolve around coming in with enough time. Credit problems, common hurdles. Again, they come to me, they have a credit problem. No problem. That can be fixed with time. So it's either the most common hurdles are either credit problems, down payment, if you don't have enough down payment, which that can either be done by saving, which is, of course, a slow process. But then we have the tools to help speed that up, the 401k loans, the gift funds. There are different types of programs, IRA distributions for people that are over 59 and a half. A lot of people forget that. There's really creative ways to qualify for income, but you just need the time to be able to look at the full picture. So I would say, yes, those most common hurdles of credit score or low down payment or issues mostly can be solved by just asking the questions. Don't be embarrassed by it. I promise you someone has lower credit score than you. I promise someone has less of a down payment savings than you. Just start that process and you will only get better from there.
Just when you were speaking, it brought to mind a funny story I heard. It's funny to me. It wasn't funny for the person buying the home or the real estate agent. They were all geared up. Everything was going great. Everything was approved. There were a few days to closing. And the client went out and bought a new car.
Yes. Happens all the time. Well, not all the time anymore because we're so good. And in fact, my business partners in red, under her signature line is no new credit. I forget what it says, but don't open any new credit. Don't make any changes to your finances. Exactly, because you would be surprised at, and those are generally kind of what I was getting back to. You'd be surprised at how many. Generally, the first-time home buyers are actually a little bit more prepared than some of the move-up buyers who think they're very solid. And it could be that same example I used before, which was a self-employed borrower that's got perfect credit, lots of savings, lots of equity, lots of everything. But on paper, their actual documented income is very low. Maybe that can be solved with some time and planning, but certainly not if all of a sudden this is thrown into. So yes, don't do anything last minute. Definitely.
Stephen, I want to thank you. It's been a pure joy having you on the show today. You're just so insightful and you make things that are very complex and difficult seem so simple. So right now I've put your email and your website, which is team009.com,
yes.
On the screen for both consumers and real estate agents if they want to reach out to you and your team, regardless of what state they're in, right? Because you do it all.
Correct. Yes, I can certainly help guide. And really, thank you, Tricia, for the opportunity. And mainly because that's what I like to do. I tell people now I have 22 years of very useless knowledge unless it's in this very specific sniper type of situation. And so if you're in that need of that knowledge, be it for real estate, mortgage, what have you, please reach out to me. It's this knowledge is useless unless it's shared. And really that's what I like to do is just share what I've learned over the years. So reach out anytime. Happy to guide.
Thank you again. And hopefully you'll come on again. We won't spend so long. We'll make it a short one.
I would love it. I love this opportunity. This is a great vehicle and LinkedIn for both of us the first time. So it'll be great to see if this gets shared to a good audience.
Yeah. Okay. Thank you. And thank you to everybody who tuned in. It's been incredible. Thanks so much.
Thanks, Tricia, for putting this on. You're doing a great service. Thank you.
Bye-bye.
Bye.